All right, let's shift gears then. Rohan Gupta of Nuvama as well is joining in on the show. We want to talk a little bit more about their outlook on the specialty chemicals sector as a whole, the take on new age chemicals, and much more. Thank you for taking time out. So, to begin with, considering that there have been few concerns for the space with respect to growth moderation, demand pressure, etc., is that going to be a huge concern?
Yeah, hi, good morning. So yes, if you look at the specialty chemical, you rightly pointed out that there has been concern on growth moderation from last, I will say, 2 quarters. We need to also understand it is coming on a very high base, which the sector has delivered last year. So in FY22 second half and even FY23 first half, we have seen that the many chemical companies, specialty chemical companies, have benefited significantly from a very strong pricing environment, and their EBITDA growth was also much ahead than the normal volume growth. It was also having some pricing element. I think that it is just only growth moderation. Probably you will see that the growth moderation may continue for another 2 quarters, and then after that we should be seeing the volume led growth mainly from these companies. I'm not much worried about the growth moderation because definitely it is coming from the very high base. What we are confident about the volume led growth and the capex led growth which these companies will continue to deliver over a medium term.
Exactly my question. We have seen a lot of capex announcements come from these chemical companies and quite large from where they stand currently, whether it's Naveen Fluorine, SRF, etc. The capex announcements have been quite solid. Which of the companies do you think stand out, and do you really believe that the demand supply situation allows for such kind of massive increase in the supply?
Yeah, definitely. That's what my point is that all these companies are putting large capex. It is primarily driven by the huge demand growth visibility. India is not only just seeing the strong domestic demand, but we are also seeing a huge exports opportunities, whether it's in fluorochemicals, whether it's in for the catering to agrochemicals globally. All these companies are seeing a strong inflows of inquiries, strong order books, and that's why the capex requirement is there. You rightly pointed once again that these companies have further topped up on their capex plans in last 1.5 years to 2 years. All the cash flows are going there, and even they are some of the companies are leveraging also their debt free balance sheet for aggressively putting on the capex. And I think that is the right strategy because this sector needs investment to cater strong demand in both domestic as well as global. So yes, SRF, Naveen Fluorine, Gujarat Fluoro, Aarti Industries, we are very gung ho on all these companies who are putting capex, and that's where I was talking about the volume growth. All these companies will be coming for in a medium term.
Putting up capacity is easy, but selling that capacity is a function of demand. Growth is slowing down. Global exports are drying up. What is your understanding of demand of the product?
So Nikunj, there are two things to understand. One is the concern on global growth slowing down. When a growth slow down, then most of the global companies will continue to focus on cost reduction. India is an opportunity for low cost destination. We are also seeing the opportunities coming from China plus one, and recently very important phenomena I think that which people are forgetting or not giving the right weightage is the Europe energy crisis. Many European companies are going to face the cost pressure because the energy cost in Europe is not going to be same what it was earlier. So you have a very solid domestic demand, a China plus one, a Europe's energy crisis, and global players' requirement to continuously bring down their cost that can only be achieved through outsourcing. So here we are the country which offers the all this advantage, and that's where, despite a global slowdown, I think that the outsourcing opportunities and domestic growth, all these things are going to drive the capacity, drive the demand for Indian chemicals manufacturer, and that's why I'm not much worried about the demand supply mismatch. or these companies who are putting capex, they will be able to use these capex optimally.
China plus one is a concept which started post COVID, and post COVID China is not has been both on and off. Now that China has opened convincingly, will there be a realistic shift in China plus one strategy? Because it's easy to discuss a strategy when China is not operating. Now is the real test.
So, Nikunj, once again, we need to understand that China has been a biggest disruptor, not only just pre-COVID, but even before that. Many of the end user industries who have been dependent on China for their requirements solely, they have been facing disruption or supply chain disruption. For a company or end user industries like FMCG or consumer durable, the disruption in supply chain is the biggest deterrent. I think that from 2015 onwards, many global companies have already been looking the alternative. It has just only increased, or intensity only increased post COVID. So, China coming back is not a solution for the global player, because they definitely need a second other alternative than China, because they have seen a multiple disruption in China. And also understand, even within China also, the cost structure has been continuously going up. Since 2015, many chemical industries, chemical parks in China has been relocated, shut down. Their cost structure has gone up massively. That's where the Indian players comes in play. We now have a level playing field. There is no extra benefit to the Chinese manufacturer, and that's where the advantage comes to Indian players now, and that's what gives us the confidence that the China plus one, or simple, it's a global end user industries are going to add one more source than China. It may be either Malaysia, Thailand, India, and I understand that India is the biggest beneficiary or the most suitable after China.
All right. And, given that we also met up with Tata Chemicals management, and they highlighted that the US is emerging as low cost penetration center for energy intensive sector. How does that augur for India?
So that is a very specific view which you are talking about, only limited to soda ash. So yes, because US have some soda ash assets, and there they have the mining process through the Trona process. So that is only limited up to the soda ash, and it's not applicable on entire chemical industry. That's the only one particular one product, and there also we think that the definitely US will have an advantage in terms of natural soda ash. But yes, synthetic soda ash still will continue to remain dominating factor, and it will all dependent on from how far they can export from the US. So I think it's only specific to the one particular product, the dynamic which you're talking about.
And we let you go on that note. Thank you so much for joining in and talking to us about how the entire dynamics is shaping up when it comes to the chemical sector as a whole. For the market, 17,050 is where we're at. So just maintaining around that level. There's not a big move either on the up